In today's The Market Report, I'll let you know why Bitcoin derivatives are pointing to a price drop below $22,000. Plus, why BitMEX founder Arthur Hayes claims that the Bitcoin bull market already began in March. Hello everyone, welcome and thanks for watching The Market Report. I'm your host Marcel Pashman, analyst and writer at Cointelegraph. The show debates the most pressing topics impacting the crypto market, focused on price changes and meaningful events. We'll start with an article written by myself. Bitcoin futures data hints at $22,000 as the next logical step. A Bitcoin price correction down to $22,000 is becoming increasingly likely as Bitcoin derivatives have begun to exhibit bearish tendencies. Price chart of Bitcoin leaves little doubt that investor sentiment has worsened since Grayscale's much-hyped legal victory against the SEC on August 29 and the SEC postponement of multiple spot Bitcoin ETF requests. The central question remains whether the prospects of an ETF can outweigh the growing risks. So basically, from one side, the bull's biggest hope is the ETF approval, which may or may not happen in the next 6 months. Given that the SEC denial basis being the excessive trading based on unregulated exchanges backed by shady stablecoins, the odds are less than favorable for Bitcoin bulls. Meanwhile, the Bitcoin bears have multiple lawsuits from the SEC against the leading exchanges, Binance and Coinbase, plus a potential indictment from the US Department of Justice regarding money laundering and facilitation of trades from Russian entities against Binance. The human brain loves a story where there's a good guy versus a bad guy or opposing forces. In this case, the government suppressing cryptocurrencies. But if we analyze the big picture, nothing has changed in the past 5 years, meaning the gray regulation of the sector and the odds of the ETF approval mean the story remains utterly similar to the previous rejections, except that this time around it also involves BlackRock. Now, if you look further from the crypto markets, we'll find an environment that is not favorable for risk assets. Such an analysis fails to consider that inflation as measured by the CPI has come down to 3.2% from 9.1%. Moreover, the US Federal Reserve total assets have been reduced to 8.1 trillion, down from the recent peak of 8.7 trillion in March 2023. This signals that the monetary authority has been draining liquidity from the markets, which is detrimental to Bitcoin inflation protection thesis. If the inflation has come down and the Federal Reserve is dumping assets on the market, why would investors flock to a scarce digital asset? That alone explains why the Bitcoin derivatives data are displaying neutral to bearish tendencies, meaning there's no demand from leveraged longs. So you have the chart of the Bitcoin futures premium at Deribit and OKX 1-month contracts. On neutral markets, it should be trading at a 5 to 10% annualized premium to compensate for the longer term liquidation, because the money will be stuck there, both for the buyers and sellers. And you can see that happened over the course of July, but as we entered August, the premium dropped below the 5% threshold, meaning there's lesser demand for leveraged longs. So the premium on the futures contracts have come down to 3.5%, which is a typical of bearish markets. And you can double check that information on Bitcoin options markets according to the 25% delta skew indicator. Basically, if the indicator is up above 7%, 6 or 7%, it means that the bearish put options are trading at a premium. So it's a neutral to bearish market. The opposite, if the delta skew is trading at minus 7%, it means that the buy options, the call options, are trading at a premium, so a bullish market. And you can see that over the last 3 or 4 days, the skew metric went above the 7% threshold, meaning we entered a bear market according to the Bitcoin options pricing. So both futures and options are signaling that a correction is the most expected outcome from professional investors. Ultimately, a retrace down to $22,000, the last level seen when Bitcoin futures premium was 3.5%, such as the one we currently have, is the most likely scenario, considering the recent inability to sustain a positive price momentum despite the heightened chances of a spot ETF approval. Don't shoot the messenger. I remain a Bitcoin bull, but derivatives and fundamental analysis do not foresee a bull run in the next 3 to 6 months. Just to highlight, that's my own personal opinion. It does not constitute investment advice or reflect Cointelegraph's official view. Now, onto the show's next topic, an article written by Jesse C. Bitcoin bull market began in March. More you'll realize in a year. Arthur Hayes. In a September 5 keynote speech at Korea Blockchain Week, Hayes argued Bitcoin's bull run began on March 10, the day Silicon Valley Bank (SVB) was taken over by the Federal Deposit Insurance Corporation. So for those unfamiliar, the SVB Bank was focused on startups, a top 20 US bank before the collapse. So not to be confused with Silvergate and Signature, which were shut down in the same week, and those happened to offer services to most of the cryptocurrency intermediaries and exchanges. In response, and in a bid to stop further possible collapses, the Federal Reserve created the Bank Term Funding Program, BTFP, offering bank loans of up to a year in return for them posting qualifying assets as collateral. So, in the words of Arthur Hayes, essentially what the Fed did was backstop the entire banking system by saying, please give me your underwater dogshit bonds and I'll give you fresh dollars, Hayes said. Now, I obviously agree with Arthur's statements, since the only reason that other banks did not collapse, especially the regional ones, was the $300 billion liquidity injection from the Federal Reserve. It doesn't matter if they're printing money, issuing bonds, purchasing worthless bonds from banks, they all mean new money in circulation. Let's assume for a second that Arthur Hayes is right, and Bitcoin's bull run started in March, given that its price increased 15% from $22,500 to the present $25,500. If the cause was increased risk perception of the US government's lack of ability to pay back its debt or the interest rates on its debt, wouldn't the US dollar itself be hurt? Because the DXY index, which measures the US dollar against other major foreign currencies such as the euro or the Swiss franc, is standing at the exact same level 6 months prior. So you can see that it started in early May at 104, 105, and it's now back to the same 104 to 105 range. Sure, it moved down 4.5% during the period, but it has recovered the entire drop. The thing is, maybe investors realize that the US losing its top-tier credit risk by agencies and paying $1 trillion per year in interest debt alone is good for the US dollar. How is that possible? Simple, because people realize that other countries will collapse first in case of a global economic recession. To prove my point, check out the Russell 2000 index, which measures the biggest companies listed in the US, excluding the top 1000. So basically, small caps that usually have much less cash positions or margins when compared to the big techs from the S&P 500. So the trend is going up. Even though, yes, we had some corrections down from 2,000 points to 1.75, but the trend is moving up over the next 6 to 9 months. We're going back from 1,700 back to the 1,900 level. So even the small cap companies in the US are performing positively over the next 3 to 6 months. That happened while every credit metric deteriorated, from housing to auto to credit card. Those companies are facing increased earnings and consequently higher stock prices. A possible explanation lies on money flowing from abroad, especially from the fixed income, since the US interest rate is above 5%, while in Europe it stands at 4%. In essence, investors will throw money to whatever is paying the higher yield or have better prospects of surviving a crisis. So in this case, the United States and the US dollar. It doesn't matter if the Federal Reserve is salvaging banks, could trigger a collapse on the economies, given that the US treasuries and the US dollar are seen as the safest options around. Now, back to the article. Hayes said even if the Federal Reserve and other central banks continued interest rate hikes to enable economic tightening, or if they print more money, then Bitcoin would still perform well. I also agree 100% with this take. Either way, choosing to accelerate inflation or letting the economy slowly die from increased interest rates, which will favor the fixed income, the scenario for Bitcoin is favorable because ultimately the Fed will be forced to inject more money into the system, so the scarce assets will perform well. So as Arthur Hayes puts, on both scenarios, whether the Fed raises or cuts, we are in a good position as the cryptocurrency industry, he said. The problem is, Arthur Hayes never said that the bull run will continue over the next 3 months. So what the data from the prior article said is that the market investors, the general sentiment is not good for the short to medium term. So yes, we could be in a bull run if you look more broadly for the next 18 months or for up to 2025, but that doesn't mean that Arthur Hayes is bullish himself for the next 3 months, so just watch out for that. Well, that's it for today. Don't forget to visit Markets Pro, our professional alerts trading platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!